Welcome to our training course, FX Markets and Financial Instruments. How do the FX markets work? FX markets are arguably the largest and most liquid financial market in the world. Each day, more than $7.5 trillion is traded in global FX markets. Thousands of participants access global FX markets, each contributing to the supply and demand of currencies, which in turn drives relative prices of currencies up and down. Several distinct market participant groups have different needs and objectives when they buy and sell currencies: banks and FX dealers, investors, central banks and corporates. Let's talk about banks and non-bank market makers, also known as FX dealers. They are responsible for an estimated 45 to 55% of total turnover. They trade on behalf of clients or to cover risks arising from client transactions. They manage their own positions and provide liquidity by quoting prices to other market participants. Their goal is usually to make profits by earning the minuscule spread between prices they quote to others. Institutional investors, such as hedge funds, asset managers, and other non-bank financial institutions, are responsible for 30 to 40% of average daily turnover. They buy or sell currencies on the back of their investment views and strategies, which can have a time span of seconds, days, or even months. National central banks sometimes buy or sell currencies to manage their own currency, diversify their own monetary reserves, support a well-functioning FX market, or other economic policies. They are responsible for only 5 to 10% of global market activity, but often may have a significant impact on market prices. Corporations and businesses that usually buy or sell currencies for their international business requirements make up 5 to 10% of the total turnover. As you can already see, FX dealers' activity is a major driver behind market volumes. Covering the risk is one of the most important principles in financial markets. It is also responsible for the volumes in the FX markets. The FX dealers, who are responsible for approximately 50% of the turnover, stand to make prices to others at any moment. In other words, by making bid and offer prices to other market participants, these market makers try to profit off the difference between the bid and offer prices. So, when someone, a client or a market participant, also known as a market taker, trades with them, they usually proactively skew prices they quote next in order to cover the open currency position or make a decision to cover the risk with another FX dealer. Essentially, FX dealers make prices to market takers by judging the market sentiment and their ability to cover risks while making a small profit for their firm. Nowadays, most of the prices are made by electronic FX trading desks, where the market-making role is done by computers that are supervised by humans. The prices they quote are constantly updated to stay in line with market prices. They are connected to the market ECNs, as well as other internal systems, such as bank portals and transaction banking services. Many large banks also employ experienced traders to provide liquidity and make profits from a deep understanding of market flows and their drivers. These traders can take advantage of market dislocation or emerging trends by proactively taking a position in foreign currencies when they perceive an opportunity for markets to move in the direction that they can predict. So-called risk takers, these traders put their bank's capital at risk. They are the first to react to market movements or the news that can affect the prices, giving them a better chance to make money in otherwise very difficult markets. Because their bets can also lose money, they have limits on how much risk they can take and are closely supervised by risk management teams. So what drives FX prices? Imagine the exchange rate is like the price of one currency in terms of another. For example, let's consider the exchange rate between the US dollar and the euro. If more people want to buy euros using dollars, the demand for euros goes up. This can happen for various reasons. Economic strength, for example, if a country's economy is doing well, people might want to invest or do business there, so they'll need the local currency, like euros. This increases demand for that currency, making it stronger compared to others. It can also happen because of the interest rates. Higher interest rates in a country can attract foreign investors looking for better returns. They'll need the local currency to invest, boosting demand and raising its value. Or it could happen because of country's trade balance. If a country exports more than it imports, it earns foreign currencies. This creates demand for its currency as other countries need it to buy its products. This is why exchange rates move the most during the events or news announcements that affect how market makers and other participants perceive any of the above-mentioned factors changing. For example, major economic data releases such as unemployment and economic growth data, assoldancy, central bank meeting announcements and changes in producer and consumer prices or inflation, or trade deficit data announcement, particularly in emerging markets. FX markets are usually good at forecasting the likely outcomes for most of the above events, but occasionally there are large surprises, positive or negative, that result in markets reassessing the value of the currencies. This may result in so-called corrections, sometimes leading to sharp moves in exchange rates. One of the rare phenomena that occasionally happens in financial markets is flash crashes. FX markets, particularly in popular currencies, are liquid most of the time, but there are periods when markets stop functioning well, often called market or flash crashes. For example, the euro weakened more than 6% on 6 May 2010, only to swiftly recover shortly after. On 7 October 2016, the pound sterling fell by a similar amount as a result of speculation about Brexit negotiations. In January 2019, the Japanese yen surged on market risk aversion. In September 2022, pound sterling fell again after the surprise government policy announcements. One common theme that unites all these events is poor liquidity and heightened market uncertainty. When market makers feel less confident in their understanding of what drives the prices and pull back from providing their own quotes. If you use structured products or leave market orders, it is important to understand the effect potential flash crashes can have on your transactions. It is also important to know about business days and market hours when you plan to deal with foreign currencies. FX markets have market makers that provide prices in many currencies, 24 hours a day, 5 days a week, and only close for the weekends. They are usually open until the US markets close on Friday evening and reopen when the next Monday starts in Wellington, New Zealand. Most popular currencies would have good liquidity around the clock, while many local or emerging market currencies have liquidity only during operational hours in their time zones. While it is often possible to buy or sell a currency on any business day, the settlement of currencies can only occur on a business day in the country of that currency. This is important to know for planning your payments and cash flows. For instance, you may purchase euros first thing on Monday morning, but won't get them until the next business day if it is a business holiday in Europe. Let's talk about different financial instruments in FX markets. The most popular and well-known type of FX transaction is FX spot. This is what most people think of when they talk about FX transactions. It involves buying or selling currencies for immediate delivery. But in case of FX spot, immediate usually means within 2 business days. FX spot transactions account for approximately 20% of the global FX market turnover and play a key part in defining where currencies trade against each other. This is how it works. When you trade, you agree to exchange one currency for another at the current market or quoted rate. It's simply a currency exchange that is confirmed right away, and settlement happens shortly after. Next, we have FX forwards. FX forwards are agreements to exchange currencies at a specified rate on a future date. These are most frequently used by businesses to manage currency risks from their business operations. An FX forward is a commitment to buy or sell the specified currency at a specific rate. If you need to cancel the transaction, it's possible, but is usually done at the prevailing market value of the contract. We will discuss practical steps of hedging using FX forwards and other instruments in the later training modules. FX forwards are responsible for 10 to 15% of total market turnover. This is how it works. You agree today on a rate and amounts to exchange currencies on the future date. This is useful for locking in future exchange rates and reducing currency risk in an international business. It is important to note that FX forward prices differ from FX spot prices. The relationship between spot and forward prices is driven by a formula that takes into account the interest rate differentials between what you could get in 2 currencies and the time of a given forward contract. For example, $1 can buy more South African rands on forward basis because interest rates in South Africa are higher than in the United States. Another way to think about it is that forward rates for the EM or high-yielding currencies usually imply weakening of the currency. This is because a deposit in an EM currency usually yields a lot more, and this can pay for keeping money in that currency. The opposite holds for the forward rates for Japanese yen versus the dollar. Because interest rates in yen are lower, $1 can buy fewer yens on forward basis. Next, FX swaps and cross-currency swaps. FX swaps are a combination of a spot and a forward transaction, used for short-term borrowing or swapping liquidity in different currencies. FX swaps are responsible for at least 40% of the global FX market turnover and are widely used by FX dealers, other financial institutions, and some, but usually the more sophisticated corporates in order to manage their own liquidity. This is how it works. You simultaneously buy and sell currencies for settlement on start dates such as spot date and agree to reverse the transaction at a later date. FX swaps can help manage short-term cash needs while also addressing future currency needs. Cross-currency swaps are longer-term equivalents of FX swaps that combine features of FX and interest rate swaps. Next, we have FX options. FX options provide the buyer with the right, but not obligation, to buy or sell currencies at a specified rate on or before a specific date. FX options contribute to approximately 5% of the market turnover. Used primarily by more sophisticated investors and corporates, FX options can be a valuable tool both for investment and risk management purposes. Here is how it works. Like with insurance, you pay a premium for the option. If exchange rates move in a direction that the option protects you against, the option can be exercised to protect your business from losses. If rates move in the opposite direction, you can choose not to use the option. Lastly, a few words about FX structured products. Banks design structured FX products to deliver bespoke features for the specific needs of their clients, often to improve investment performance or lower the costs of hedging. They can be a powerful tool in experienced hands, but also harmful in certain situations. This is why banks often limit what FX products they offer to smaller, less experienced clients. It's essential to carefully assess the terms, risks, and potential benefits of FX structured products. Due diligence, seeking professional advice, and thoroughly understanding the product's features are crucial steps to make an informed decision. Here are some areas to consider when dealing with FX structured products. Complexity. Many FX structured products have intricate payout structures that can be difficult to understand. This complexity might lead to misunderstandings about how the product works, including its risks and potential returns. Lack of transparency. Some structured products might not provide clear information about how they are constructed or the fees involved. This lack of transparency can make it challenging for clients to fully assess the product's value and potential risks. Hidden costs and liquidity risk. Many structured products might have limited secondary market liquidity. This means it could be difficult to sell the product before maturity, potentially leaving clients with few exit options. There could also be hidden fees, commissions, or markups associated with FX structured products. These costs can erode potential performance and negatively impact overall strategy. Mismatched objectives. Some structured products might not align with a client's risk tolerance, goals, or time horizon. It's important for clients to ensure that the product suits their individual needs. Last area to cover in this module is accessing FX markets. Depending on the size, degree of sophistication, and requirements of a particular business, there are different routes to access the FX markets. Smaller businesses would typically access FX prices and transactions as part of their business banking account. An estimated 60% of SME companies continue to perform their FX transactions with major banks where they keep their accounts. Typically called business banking accounts, they usually come with high FX transaction costs, as high as 2 to 3%, and limited functionality, such as buying currency for cross-border payments. Neobanks, fintechs, or some specialist currency firms offer better FX spreads as low as 0.25 to 0.75% for similar products, cross-border payments, and related FX conversions. Single dealer FX platforms are an alternative that is suitable for larger businesses. Companies that convert several $100,000 or euros or pounds on average per month can also use dealing platforms. Corporate banking clients of large banks can access the single-dealer FX platforms of their banks. These are specialist portals for managing FX needs. Designed to make currency trading fast and easy for trained finance staff, these platforms often include widgets that enable you to set up specific currencies that you may want to follow, as well as market alerts, trading of a broader range of financial instruments and main market news and updates. Larger corporations often have multiple banking relationships and often want to be able to see which bank provides them with the best prices in a given currency. They can use multi-dealer platforms such as FXall and 360T to consolidate their FX trading on one platform and streamline the process of obtaining multiple quotes. Similarly to single-dealer platforms, multi-dealer platforms are best suited for experienced treasurers, finance directors, or FX dealers because they require training and are most often used to transact in larger amounts. Lastly, businesses with large number of FX transactions may consider automating FX with APIs. As increasing numbers of businesses embrace APIs, it is now possible to manage business currency needs programmatically. Fintechs such as HedgeFlows offer public APIs where their clients can buy or sell currencies with minimal need for manual interventions. Combining transparent competitive prices with the ease of use thanks to modern technologies, APIs are an emerging trend in streamlining currency management for businesses of all sizes. When choosing an option, businesses should consider their budget, trading volume, ease of use, customer support, and regulatory compliance. It's important to ensure that the chosen platform or service aligns with the business's needs and objectives. While small businesses might have limited access to complex FX products, they can still benefit from basic solutions that help manage currency-related risks and facilitate international business activities. Thank you for listening to our training module. Please consider taking the short quiz to review the topics we have covered.